Hey there, everyone. Dave Keller here with Market Misbehavior, President and Chief Strategist at Sierra Alpha Research. And thank you so much for joining me here on my weekly show on Stockcharts TV. This is a special National Championship edition of my show in honor and in celebration of my Ohio State Buckeyes winning the national championship. It has been over 10 years and long overdue, some would argue, but I enjoyed it a great deal. And if you support the Buckeyes like I do, enjoy it, because I definitely am. And if you're not, I hope that at some point in the years to come that you experience your team winning the championship, because would recommend, 5 stars, would definitely recommend. With that in mind, right, the market's having an interesting start to 2025. Quite a few changes, and what I wanted to do on today's show was talk to you about some of the ratio analysis tools that I use to understand how conditions are changing. A lot of times we think about, questions are asked about, small caps recovering, small caps versus large caps, growth stocks like technology and consumer versus value stocks like healthcare and industrials, offense versus defense. And at the end of the day, what you need to do to understand these relationships is use charts that help you understand comparative analysis, right? A lot of charts that we look at, if you're looking at a stock with some indicators like RSI and MACD and moving averages and all that, it really helps you understand that particular chart and maybe the timing aspects of potential entry and exit points, but it doesn't really help you understand or define how that chart compares to other charts out there. And I would argue for an equity or ETF-based investor, that's the game, right? Is understanding this particular stock or ETF that you're buying, is it a better opportunity than all the other stocks or ETFs you could be buying on any particular day? Now, one part of the toolkit that we often talk about, relative strength, which is looking at a ratio of a stock or ETF versus its benchmark, is a version of this ratio analysis that we're going to talk about. Now, I hope you know by now, and if not, I hope this is a great introduction to the fact that Stockcharts.com provides some fantastic resources, great database covering a lot of different global markets and deep indicators about the U.S. markets. And there's ratio tools that you're able to easily create using the chart lists and grouping them together using the chart lists, I think give you such a fantastic opportunity. And so I have a chart list just called Ratios, which helps me understand some of these comparative relationships. I'm going to share with you some of the charts that I use, that I refer to in that Ratios list. You are welcome to these charts, and we'll have a link in the description to access this list of charts. And I hope you're able to check them out and save them to your own Stockcharts login, which you should definitely have and which you should definitely do. So 5 ratio charts that I'm going to show you today. The first one is large caps versus small caps. That's actually not true. Growth versus value. As I was saying that, I look at the time, I'm like, no, I think growth and value are better to start with. We'll start here. Although, surprise, large cap versus small cap is coming up very, very soon in this list. But one of the basic, I think, premises that defined the market for much of 2024 was growth stocks outperforming value stocks, right? Generally speaking, and certainly at times in the first quarter and definitely the fourth quarter of 2024, we saw growth sectors, things like technology, communication services, outperforming value sectors. And those could be things like energy and financials, but also defensive sectors like utilities are in the value space. Growth generally has been outperforming value for a number of years. On shorter time frames, we've seen periods where value stocks start to outperform, and I would argue that the conditions may be setting up for value stocks to re-exert themselves in a leadership role. As a matter of fact, value stocks, by most measures, have actually been outperforming growth stocks at the beginning of 2024, depending on what ratios we look at. So this chart here is one of the charts that I use to think about growth versus value. Now, I will tell you, I'm not showing the RRG charts in this particular video. I am a huge fan of Julius de Kempener's beautiful visualization, helping you understand the 11 S&P sectors. So I would encourage you to use that visualization along with some of the charts that we're showing here to really understand leadership rotation and what is emerging in a new potential leadership role. I think that's where the RRG is so valuable. But again, this ratio chart, this first one, helps you understand the relationship of the growth sectors versus the value sectors. Now, there are a number of different ways we can try to make this particular analysis, but all of the charts that I'm about to show you are using a similar kind of format. This is a chart style that I saved called the ratio chart style, and I did it because I was doing a bunch of these comparative relationships and visually representing them. And I kind of came up with a good structure that helped me analyze think about the comparisons very, very well. So the charts basically are all going to look like this. I'm looking at mostly 2 years of daily data. And the way that you construct these charts is by doing a normal chart and just doing a ratio of ticker 1 versus ticker number 2. You can see that here. Where is it? Well, right up here, actually, at the top, you can see IWF:IWD. So that first ticker is the numerator. The second ticker is the denominator. Don't worry much about the value. That's just the value of one price divided by the other. What's more important is the direction and especially the inflection points. When you see a ratio that is going one way and then it turns. That's one of the things that helped me understand in July of last year. We were having quite a rotation in leadership because you'd had some growth stocks really emerge in a position of strength. All of a sudden, July into the August low last year, we saw value sectors start to improve. Some of the defensive sectors actually started to do pretty well. Then growth took on a leadership role yet again and went higher. And the reason why I can make that assessment using this chart is this is a ratio of the growth ETF, the Russell 1000 growth ETF, so kind of large mid-cap stocks, and the over the Russell 1000 value ETF. So a large mid-cap universe, let's look at the growth stocks versus the value stocks. When this ratio is going up, growth is outperforming. When the ratio is going down, value is outperforming. Now note how you've had a number of periods here where for about 4 to 8 weeks, we've seen value outperform. But every one of those times, especially over the last couple years, we have seen a rotation back to growth. So growth has taken a backseat at times, but for shorter periods of time, and then value has often value has led for a little bit, and then has again sort of stepped back as growth stocks outperform. And we saw that particularly in December of last year, going into a peak in this ratio in mid-December. But if you look at what's happened from that point on, the ratio is going down, which means value sectors or value stocks have been outperforming growth stocks. And you've seen that if you look at year-to-date returns in 2025 through the end of last week. Energy, industrials, healthcare, those are probably the 3 top sectors, I would guess, or something similar to that. So it's been more value leadership than anything. Now, I have 3 ratios here, so why the 3 different charts? So there are a lot of different ways to look at any particular comparison. I would say anytime you're looking at a growth versus a value ETF, which is really based off of indexes that the ETFs are based off of, those indexes make a lot of assumptions, right? Indexes could be weighted certain ways. They could have an equal weighting or a market cap weighting or a price weighting. Any one of those construction nuances could dramatically, in some cases, change the performance of the indexes and as a result, the performance of the ETFs. So I have a couple different ways of thinking about growth versus value. The first one, as I mentioned, kind of large mid-cap growth versus value. Those are the Russell 1000 growth and value ETFs, tickers IWF and IWD. The next one down, Invesco has a pure growth and pure value ETF. And here's why they have that. If you think about stocks that are more growthy and more value-y, they're really not just 2 separate buckets, right? And everything is either a growth stock or a value stock. It's more like a bell curve, right? And certain things, that's probably true, probably more like a double bell curve, I guess, right? Where there are some stocks that are clearly growthy and some stocks that are clearly value, but then there are stocks that kind of overlap. Maybe a Venn diagram would be a better way of describing this, I guess. So there are some stocks that actually satisfy both. And Microsoft is kind of a classic example. In some cases, it represents a mature value company, value-oriented company, a blue chip company, fairly stable, has been around a long time, has pretty mature business lines in some cases, but it also is demonstrating some qualities of a growth company, still seeing explosive growth numbers at times into AI and sort of growthy, aspects of emerging technology. So as a result, it's kind of both. So a stock like Microsoft actually fits into both buckets. So these pure growth and pure value basically ignore those things that overlap in the Venn diagram, and it looks things that are just purely on the growth side or purely on the value side. So one would argue maybe it's a more pure or more clear representation of the performance of actual growth stocks versus value stocks, and ignoring those ones that are double counting. So worth noting a bit of a difference right now between these two. The growth to value kind of traditional relationship going down. The pure growth to value actually spiking higher going into this week. Something to certainly watch. And I would just say what this tells you is think about which stocks are included in this ratio that are not included in that ratio, and that probably tells you why the differences are there. The third one I have at the bottom is a ratio that I like to follow called high beta versus low volatility ETF. If you go back on Stockcharts TV and look for some of my interviews with Ari Wald of Oppenheimer, and most recently I interviewed him for my podcast, but I don't think he actually showed that ratio. So stick at Stockcharts TV, look through, just search for Ari Wald's name on this channel, and you'll find some interviews where he included that ratio, so you can get an idea of how someone other than me is using it. But high beta sectors are kind of growthy, right? It's things like technology, and low volatility sectors are sectors that move a lot less than the overall market. So they're more defensive sectors, which are more value oriented, like utilities and real estate and things like that. So the idea when high beta is outperforming low volatility kind of implies that growth is outperforming value, although that's not a perfect match, pretty safe assumption. And then the opposite if it's going lower. So, where are we at right now here in mid-January 2025? Well, growth has been underperforming value using the traditional indexes. The pure value indexes are suggesting growth is actually stronger than that first one might imply. And that means maybe some of those conglomerate names are weighing on the index. And then finally, at the bottom, we have high beta versus low volatility, which has been trending higher since a major low in early September. So that's really saying risk off right now, or risk on in the fact that, the higher beta names are outperforming lower volatility names. So first set of ratios, I think, are focusing on growth versus value. I would encourage you to start there. Second bucket, we want to think about small companies versus large companies. Again, lots of ways to do this. Two ways that I'm showing you here. One is a ratio of the IWM versus the SPY. So this is the Russell 2000 ETF versus the S&P 500 ETF. So smaller companies versus larger companies. The general trend over the last 2 years has been clearly favoring large over small, and I can tell that by the fact that the ratio has been gently going down there through for almost the entirety of this look back period. But if you look at the last 6 months, small caps really aren't underperforming by a ton. And there actually been some periods like in July of last year, like in November of last year, where small caps actually started to outperform. Now, of course, that happened back in November, December of 23, before 2024 began, and small caps again took a backseat to their larger cousins. I think this is a key chart to watch in 2025 because there have been some serious tailwinds for larger stocks, right? The dollar has been weaker for a while. Interest rates lower for a long period of time. That has tended to be a challenge for small cap companies. All of a sudden, you're starting to see that rotate a bit higher, and particularly the stronger dollar could be a great tailwind to this ratio going higher because, as we've covered many times, actually my last Stockcharts TV video from last week particularly talked about small caps as a potential leadership area and what we would need to see. And the short answer is the stronger dollar is certainly part of that because a stronger dollar could weigh on mega cap companies that have a lot of non-U.S. revenues. Smaller companies are pretty much immune from that particular issue. So a stronger dollar could be bad for large caps and as a result, probably better for small caps. The sector thing has a big impact here as well, though. Remember that the Russell 2000, the biggest sectors are industrials, financials, healthcare. These are sectors that have been doing quite well recently, are very much more in the value space, are not growthy sectors. The small cap ETFs are much lower weighted on growthy sectors like technology, which makes up about a third of the S&P. It's one of the medium-sized industries or sectors represented in the small cap ETF. So this is another way to think about value over growth. If value starts to outperform, look for small caps to start to do better potentially as well. The other ratio I have at the bottom is the S&P 500 on an equal weighted basis versus the S&P on a regular kind of cap weighted basis. The ticker for the equal weighted S&P ETF is RSP. That tracks an equal weighted S&P index. And then SPY, of course, is the regular cap weighted ETF. So when this ratio is going down, that means the equal weighted version is underperforming the cap weighted version, which means that the largest companies are doing better. And that's why the equal weighted version, which is lower weight on the mega caps, is underperforming. So that is bouncing a little bit here in the new year, and this is why this is an emerging trend to watch as well. We haven't seen an environment for quite some time, for multiple years, where the equal weighted S&P has been outperforming the cap weighted S&P for a period of time. That's because the Magnificent Seven stocks have been so dominant, back to when we call them the FANG stocks. When those are working and doing so well, there's such a big weight in the benchmark, they literally pull the benchmarks higher. And so equal weighted versions of the S&P are going to underperform. Watch to see if and when either of these ratios go higher, and that would be, really represent a major change in leadership from what we've experienced in recent years. At some point, that's most likely going to happen. This will be the chart to track that potential rotation higher. The third set of ratios I would follow to really understand the equity environment would be offense versus defense. Now, I have a chart that I often show that uses the XLY versus the XLP. This is consumer discretionary versus consumer staples, or things you want versus things you need. The argument here is when conditions are good, when consumers are optimistic, they have money to spend, they're willing to pay for travel, tourism, new stuff, new watches, new clothes. These are all in consumer discretionary. You don't need them, but they're nice to have when you want to splurge a little bit. Excuse me. Consumer staples are things like beverages, toilet paper, alcohol, tobacco, cleaning products, personal care products. These are things that, regardless of what the economic conditions are, regardless of what sort of money you have, you're probably going to want to pay for those kind of basic necessities of human beings. And so consumer staples are kind of immune to economic conditions because we're probably going to spend money on that no matter what. And it's not like when things are really great, you go out and buy really nice toilet paper, like you just kind of need it around the house, right? So the XLY to XLP is a great way of tracking offense versus defense. When consumers are optimistic, when investors are optimistic about consumer behavior, the ratio is going to go higher. And indeed, that's what we've seen from the August low last year. This ratio has generally been trending higher. Now, the problem with this particular ratio is the XLY is very top heavy, right? So 3 stocks make up about a half of that ETF: Amazon, Tesla, and Home Depot. So by looking at an equal weighted version of that same ratio, we can kind of take that mega cap effect away and just make sure, sort of double check. When I look at the equal weighted versions, is that also going up? And indeed it is. In this case, we see both of those ratios going higher. And here are the tickers for the equal weighted consumer discretionary and consumer staples: RSPD and RSPS. Now, if you look at the bottom, one other ratio I think is kind of an interesting one, a little different: hotels versus utilities. I had a guest on my show on Stockcharts TV years ago. Forgive me so much, I can't remember who it was. At some point, I'll have to go back through some videos and figure it out, because I think it's a really interesting one. Hotels are the kind of things that are sort of a pure luxury play, right? I mean, it's like going out and traveling. Sure, there are a lot of business people going out and going to hotels for work travel, but more and more, it's the strength of those stocks is driven by consumers willing to travel and wanting to treat themselves. And so hotels are pretty sensitive to economic conditions. Utilities, very much not so. It's worth noting this ratio from mid-December now to mid-January starting to turn lower. Now, there's some nuances there, of course. I mentioned business travelers with, using hotels. Utilities are growthy at times because they, a lot of the needs of AI and cryptocurrencies requires a lot of energy. That means utilities are, becoming a way to play that growth in things like AI. For what it's worth, though, the ratio turning lower means hotels are underperforming utilities. None of these ratios so far are great timing tools, right? It's not like I would manage a portfolio based purely on the ratio of these two equal weighted ETFs. But in terms of understanding the landscape, in terms of recognizing changes in leadership, this is where I feel like these ratios are so valuable. Because a lot of times what happens is something leads, right? So consumer discretionary leads staples for a while. Our brains have an issue. It's called a recency bias, where we basically assume that whatever has just happened is going to keep happening. So the conditions will change, but unless we routinely revisit these ratios, we won't realize that it's changing. And as a result, we'll miss the fact that all of a sudden defense is outperforming offense. So I have some of these charts as part of my Market Misbehavior Live chart list, which is a set of charts I review every single day. I would encourage you, number one, you should definitely be a Stockcharts member because it is the most underpriced and undervalued resource on the internet, I would argue, here for an investor. Great capabilities for a relatively low cost, for sure. And I would say creating a chart list with some of these these ratio charts and at least going through every week and just reviewing and making sure you understand what's working and what's not. That's where I think it can add a great amount of value to your process and hopefully keep you in the right things. All right, that was the fourth one. That was the third one. Fourth ratio is more taking a step back. We're actually going a little micro to macro this time, but again, keep it simple and look at stocks versus bonds. It kills me when people diversify just for diversification's sake. What I always remind people, and as a momentum-based investor, what you learn is that when you just blindly diversify to like 5 different things, chances are 1 or 2 of those at any one point are underperforming in a big way. And if you would simply stop investing in the stuff that's really not working and just rotate those assets into the things that really are working and just keep rinse, repeat, keep doing that over and over, you're generally going to be able to outperform because what you're doing is following the trends, right? And that's what relative strength investing is all built on. It's identifying what's working and leaning into those things, identifying what's not working and leaning away from those, and just continually rebalancing into things that are working. This chart of stocks versus bonds, and I'm just using 2 ETFs, the SPY for stocks, the TLT representing treasury bonds. Look at how this ratio has consistently gone higher. Now, a couple of the big drawdowns in the last couple of years have been noted by this ratio going lower. So in the fourth quarter of 2023 and the third quarter of 2024, those are the 2 periods when that ratio went down quite a bit. And certainly those were some of the bigger drawdowns that we've seen in the equity space. Having said that, this is a reminder that even though we might think about bonds as an interesting place to have some of our assets, this shows you that the 60-40 sort of method is not generally, has not been a very profitable approach. And to the contrary, just owning stocks over this period has been dramatically better. Ratios like this that remind you how one asset has outperformed another, I think incredibly valuable. Not something you need to look at every day, but just look at it once a week as a reminder of what the long-term trends have been and what it costs you to be allocating away from some of the leading areas of the financial markets. I'll leave you with this last one. The last one is stocks versus gold, or what we would call paper versus rocks. Think about stocks as paper assets. Think about gold as hard assets, right? Something that is a physical thing that has a value because we all think it does. This ratio of stocks versus gold, I would argue, is what the market actually feels like. And I've mentioned this before, but I'll just show you. If you look at this is kind of the S&P 500 using a similar sort of chart treatment, right? So here's the S&P in dollar terms over the last 2 years. And let's look at a same time period here. Here's the same time period of stocks in gold terms. So the SPY divided by gold. So there's stocks on their own in nominal terms. Here's arguably stocks in real terms because we are looking at them relative to the price of gold, which is arguably more of a stable store of value. The fact that there's this much of a gap with stocks going well beyond their previous highs and going higher, but stocks in gold terms still well below their previous highs, this is why, even though the market has been going higher on an absolute basis in nominal terms, it doesn't feel as good, right? It doesn't feel like the gains have been that good, and that's because basically of the devaluation of the dollar. Your dollar's worth less, and that's what the S&P in gold terms kind of shows you, that relative to a hard asset, the value of the S&P has actually gone down over the last year, right? So we're in a bear market, apparently. This ratio, I think, is really helpful because if you felt over the last 12 months that the market is doing quite well, but it just doesn't feel like, why do we not like this bull market so much? I would argue this is why. It's because in reality, the value of the S&P going up is just not there, right? The S&P is less valuable than it was a year ago in terms of gold. So this sort of ratio analysis that helps you understand the relationship between one asset class and another, I think is really valuable as well. And also just putting the movements in equities into proper context. Those last 2 charts, I don't look at every day, but I do keep them on a list that I do look at pretty regularly. About once a week, just to remind myself, okay, this is what's actually happening underneath those. This is what the market feels like based on these relationships. The other final point here, and then I'll wrap up the show, is just to point out that extremes can be very helpful. A lot of these charts, I did not put an indicator indicator like RSI at the bottom. But I would say I use very few technical indicators with ratios like this because I prefer to just think about the ratios as descriptive about the market conditions. Use things like moving averages for sure. But I would say with something like stocks versus gold, especially something that's more of a mean reverting kind of noisy data series, using RSI as a way of identifying when it's at an extreme and when that extreme reading may be alleviated to the upside and to the downside, I found to be very, very helpful for identifying some of those counter trend moves when something's moved aggressively in one way and feels like it needs to mean revert the other way. So there you go. Those are 5 ratio charts that I would certainly encourage you to think about and follow. We have a link in the description for a chart list combining those 5 different charts. I hope you will take those and apply them to your own Stockcharts login and follow them going forward. Don't forget, by the way, to watch my market recap show called ChartList with Dave Keller every weekday after the close on my YouTube channel called Market Misbehavior. Have a great week, and remember, it's always a good time to own good charts.